In this section, we want to look at property, plant, and equipment, which is dealt with in Ipsas 45. This is a very important standard because a lot of public sector entities have huge investments in property, plant, and equipment. So the accounting for PPE, as it were, becomes very important, and that's what we're going to be looking at in greater detail. So just to provide an overview of this section, what we're going to cover. Number one, we're going to define what is PPE so that we've got a good understanding and how do we distinguish it from the different types of other assets that we might have in our balance sheet. We look at recognition, what needs to be met for us to recognize PPE in our books. We then look at measurement, which is initial measurement as well as subsequent measurement. Then obviously derecognition and disclosure. We're going to look at some of the issues, practical issues around PPE. So let's get right to it. Background to the PPE standard. So PPE standard is at the time we're doing this course, it's still relatively new. It was issued in May of 2023 and becomes effective on 1 January 2026. But obviously providing an option for early adoption. I know that Zimbabwe in the Ipsas implementation journey decided to early adopt the standard starting 1 January 2023. So that's still very new and replaces Ipsas 17, which had been there for a while. But in terms of its relationship with IFRS, this standard is based on IAS 16, which is the IFRS standard that deals with property, plant, and equipment. So for guys that know IAS 16, one of the easiest way of bridging the gap between IAS 16 and Ipsas 45, if you go to the back of the standard, they then do a comparison between this standard and IAS 16, and you can actually see the areas that you need to focus on. But for this course, we're going to be covering everything that relates to PPE in this standard. Definition of PPE. So let's start by defining what is property, plant, and equipment. So PPE, these are number one, tangible assets that are used in the production of goods and services or the provision of different services, and are expected to be used for more than one accounting year. So what we are saying here is you're looking at tangible assets, which then distinguishes PPE from assets that are intangible, and then are used, number one, for rental to others, but also in the production or the provision of services, and also at the same time, they can also be used for administrative purposes. But obviously, the key thing here becomes that we expect to use these assets for more than one period. So as you talk about the definition, let's talk about the key considerations when you're looking at PPE. So PPE is different from inventory. Why? Because when you're talking about PPE, we are saying that inventory is used in one accounting cycle, whereas PPE is expected to be used for more than one period. So that's already distinguishes PPE from inventory. Number two, PPE versus investment property. PPE is different from investment property. Investment property, we are looking at land and buildings for rental to others, whereas PPE, if you're looking at if you're renting out equipment, that's not investment property, that is PPE. PPE primarily, we're talking about owner-occupied property, and to the extent to which we are renting out, we are dealing with non-assets that are not land and buildings. Then PPE versus intangible assets. We are also saying that intangible assets do not have a physical form, whereas PPE are tangible assets, so they're clearly different. Then PPE versus biological assets. So biological assets are mostly covered under Ipsas 27, which deals with biological assets related to agricultural activity. So all biological assets related to agricultural activity would be dealt with in Ipsas 27. The only exception are bearer plants, which the standard says must be accounted for in Ipsas 45. So what are bearer plants? These are things like your plantations, where the plant itself then bears agricultural produce. The produce will still be accounted for under Ipsas 27, but the plant, so if you've got a citrus plantation, those are bearer plants. If you've got any other plantation, it will be a tea plantation. As long as the period is more than a year, those bearer plants will still be regarded as PPE. So that's the only agricultural biological assets related to agricultural activity which is accounted for as PPE. However, a lot of other biological assets which have nothing to do with agriculture are still regarded as what? Are still regarded as PPE. So for example, if you go to police, they'll have horses, they'll have dogs. All these will be regarded as property, plant and equipment and accounted for under Ipsas 45. So that is just the distinction of PPE and other different types of assets. Now we want to cover just some practical considerations around PPE classes. So in terms of classification, when you have a PPE class, when you have PPE, you must then further break down your PPE into the different classes. And this helps the accounting. So why this is important, you'd find that when you are developing an accounting policy, you don't do it at PPE level, but you do it at class level. So there becomes very key considerations that once you've got an accounting policy, it has to be applied by assets within that particular class. So for example, if building is a class, all buildings will have the same accounting policy. So you can't then pick and choose to say these buildings will have different accounting policy. So once you've set it as a class, all the assets within that class will use the same accounting policy. So that becomes very important. So examples of PP classes that we could have is we could have a class of land where you put all the different types of land. It could be agricultural land, it could be commercial land, it could be any land that the entity is holding. So that becomes land. We could also have a class of buildings where you put different types of buildings, commercial buildings, residential buildings, school buildings and the like. So we've got the public sector, we've got lots and lots of buildings. You could also have a class of infrastructure assets where you put all infrastructure assets. You could also have a class of ICT equipment where you're talking about computers and all ICT related equipment would go into that class. I'm just giving out examples here. You could also have a class of transport equipment where you put motor vehicles, trains, aeroplanes, bicycles, anything for moving people and objects. So that's transport equipment. You could also have a class of biological assets where you put, remember the biological assets that we spoke about, which falls under PPE. You could also have a class, very important class of assets under construction, which means when you are doing construction projects, initially you put these assets in a different class until they're completed, then you move them to their relevant class. So one of the key considerations, particularly when you're implementing Ipsas for the first time, and you come to PPE, is defining the different PPE classes. Because from there, it then allows you to then say, what is the accounting policy that I'm going to use in the different classes? Please just take note that personally, this is me. There are certain classes which you can't have the same accounting policy. For example, I've seen a lot of entities that combine land and buildings, and it's difficult to have the same accounting policy for land and buildings. For starters, land is not depreciated, but buildings are depreciated. So I always encourage that separate land from the different other types. It could be buildings or it could be infrastructure assets. Those two should be separated. We want to talk about recognition of property, plant and equipment. So here there's a recognition criteria. Before we decide to put PPE in our books, we must be able to say what criteria should be met for us to actually say we've got PPE. So the first one, which is related to what we spoke about when we're dealing with the conceptual framework. Number one is economic benefits. So, and service potential, obviously. So PPE, when you've got a PPE item, you should be able to demonstrate how you expect to derive economic benefits from it or service potential, which I don't think a lot of PPE investment would fail to make. If there are no economic benefits, you should be able to demonstrate the service potential. Service potential is a fairly complex way of looking at assets because of the the nature of service, potential. So it doesn't mean that, for example, you could look at an entity could spend exactly the same amount of money and build a bridge in two areas. An area which is very densely populated, where you've got maybe 100 people utilizing that bridge, and then someone would say, why wasn't this spent in an urban area where there are more people? But the issue is the service potential is just not based on the number of people. Sometimes there could be an element of safety. So the concern of this bridge, where it's in a village and there are fewer people, was that people were crossing flooded rivers and we had more deaths. So the service potential is to reduce the number of deaths by people attempting to cross flooded rivers. That is the trigger. So you're not just looking at service potential from the number of people benefiting, but from other objectives that you're also trying to satisfy. Then you also look at, so we're talking about the recognition of PPE here, is you can only recognize PPE if you're able to reliably measure it. So you see that becomes a very important aspect when you get to assets like, for example, heritage assets, which Ipsas 45 requires that they must be recognized. But sometimes is having a model for reliably measuring heritage assets because of their uniqueness. So heritage assets, one of the things that makes them unique is that is the only one like that. There is no other like that. That's what gives them heritage value. So sometimes you're not able to reliably measure it. So for you to recognize PPE, you should be able to demonstrate that you can reliably measure it. Now, in applying the recognition criteria, you must also understand that sometimes it's also at initial stages where you're getting the PPE for the first time. So you're looking at whether the expenditure you're incurring, does it meet the recognition criteria initially? But you should also look at subsequent costs. So in certain instances, you can spend more money after the PPE is already in use, and those costs can still be eligible for capitalization, right? So an example is, for example, we construct a building and we're already using it. Then after maybe 2 years down the line, we then decide to maybe put up an elevator within that building. So these are already subsequent costs which are being spent on the building, which is still eligible for capitalization, but it was not done in the initial instance, it was done whilst the building is already being used. So we must always consider that. I want to cover specific items related to PPE. So the first one that I want to deal with is spare parts, and the question is, are spare parts property, plant and equipment, or are spare parts inventory? So when you talk about spare parts, we're talking about certain items that we buy in order to use when an original part is no longer usable. So an example is you could have a stock of tires for the motor vehicle, so that if any of the vehicles on your fleet and any of the tires go bust or unusable, you can quickly replace. So that becomes spare parts. You can have a stock of engines. If an engine knocks, you can actually quickly replace, and then there is minimum interruptions on the work that you're doing. So most spare parts are generally regarded as inventory rather than property, plant, and equipment. So we put spare parts in inventory. So in most instances, they are by and large inventory items. But the trick comes when you then replace that spare part, you then replace the original part, what do you do? So it now really depends on whether does this spare part increase the value of the asset or not. So I'll give two examples so that you understand the principles here. If I've got a stock of tires, which I need to replace if any of my cars, tires on my cars is punctured. So if a tire is punctured on a vehicle, that does not reduce the value of the vehicle. So you can't say a vehicle is impaired because the tire has gotten punctured. So what it means is when you replace that tire, you have not done anything to increase the value of the motor vehicle. So typically when you then replace the tire, you then expense the cost of that tire. So you're not going to capitalize the cost of that tire on the asset, right? I hope that is clear. Now let's look at another example. Let's say I have got an engine which I would like to replace, and then so if I've got a truck and the engine knocks off, so there is something happens to the engine that it becomes unusable. Before I replace it, there is evidence that that motor vehicle is impaired because of how significant the engine is. So for example, if you're trying to sell the car, one with the engine that is working and the other one with an engine that's not working, clearly the expectation is that the one with an engine that's not working will fetch much lower value. So the damage to the engine, which makes it unusable, is an impairment. So the expectation is that you should write down impairment on the car. What this means is if I then replace the engine, the new engine that comes is increasing the value of that truck. So clearly the new engine is capitalized. So what's the process that I must do? It's therefore important that before I bring in the new engine, I must de-recognize the current engine which has been damaged, which is on the car, before I can recognize the new engine which is coming. That's very important. Otherwise, if you just capitalize without de-recognizing the old engine, you run the risk of now overvaluing your asset. So that is spare parts and just the issues around spare parts. The next one, in terms of our specific items, is standby equipment. Should standby equipment be capitalized as PPE, or should we treat it as inventory? So standby equipment is PPE in most instances. It meets the recognition criteria. Its use is to be on standby. So it's pretty much in use. So when you put it in, you should be able to start depreciating it because it's already doing the work it's doing. So if you've got a generator on standby, it's already in use because its role is to cover for the main equipment. If anything happens, it kicks in. Let's say the electricity, you lose, there's no electricity, there is a fault. The expectation is that you're going to use the standby equipment. So it's already in use, that is its job. Then servicing equipment, this is the equipment that is being used to service other equipment. Now this one, it really depends on the type of servicing equipment. Some instances you could have tools which are generally not material, and some instances those tools can then be regarded as inventory. But in some instances you could actually have a whole workshop which is used to service motor vehicles. In that case, clearly it's capitalized. Right. So these are different specific items that I just thought I should cover. Now, still dealing with specific items, these are another different types of specific items, which I think are just for emphasis point. These are very unique to the public sector. That's why I'm dealing with them as well. So the number one is weapon systems. So weapon systems are also part of your property, plant, and equipment. They should be capitalized. So we are talking here about weapon systems like your guns, your different motor vehicle, weapon, the rocket launchers. You're talking about your, I don't know the specific names, but I'm sure if you just have a picture of war and you're seeing all that equipment, that forms part of your weapon systems. So and some weapon systems are more, they could be one use, but they're more deterrent. So they're positioned to prevent any attack. So on that point of view, they still become part of our PPE. Then another very important category is infrastructure assets. Infrastructure assets, what distinguishes infrastructure assets from other assets is that infrastructure assets are pretty much to serve a community or a society or a large group of people, unlike other assets which are really not meant, like for example, when you look at land, it's not really for use by the whole community, it's used by whoever owns the land. But when you're talking about infrastructure assets, they are really put there for the community. So we are talking about things like roads, which are used for public purposes. You're talking about infrastructure, about the sewer system, which is used by the residents. You're talking about lighting systems. You're talking about stadia. You're talking about, all the different types of infrastructure that we could think of. All this still forms part of our property, plant, and equipment. And when I did the discussion on classes, we actually said you could have a class of infrastructure assets. They are very complex nature because they talk about systems. They're not just, it's not just one asset like we've seen with land or buildings. This one would be a complex network of systems. So think about your utility lines, your electricity lines. You've got the lines, you've got the substations, you've got the transformers within that whole range of equipment. So you'd have multiple different types of assets that forms that infrastructure assets. Then we also have heritage assets. Heritage assets, these are assets that are very unique. They've got historical significance, they could have cultural significance, or any other significance within the country. And one of the characteristics of heritage assets is their uniqueness. So they are irreplaceable. So once you lose it, you can't replace it. So for example, if you've got a heritage building, if it's gotten down by fire, you can't rebuild it. What you've rebuilt is no longer a heritage asset. So that's sort of the uniqueness. And people love the uniqueness of it because of the historical significance. And just to emphasize the point that it's not replaceable, I'll give you an example of, let's say we've got a king like Mzilikazi or Lobengula, or those old kings in 100 or 200 years ago, and we've got their spear, the spear that they used to war as a heritage asset. It's not like the spear is the most well-made spear. We could still make, now technology, probably can make better spears. We can make more effective spears. We can much nicer spears. But what gives this heritage value is that it belonged to a king, right? So that's where it derives its heritage value. So even when you're valuing it, you're not just looking at how much does it cost me to make a spear, because that's not what gives its heritage value. Its heritage value, people will pay lots of money for it simply because it belonged to a particular king, right? That's where the heritage value comes from. Now we want to talk about initial measurement of items of property, plant, and equipment. So once they've met the recognition criteria, which you've spoke about, you've classified them, and now you want to put them in the books. The question is, at what amount are you going to put them? So we want to start dealing with the initial measurement. So the standard says that you must recognize the assets at cost. Okay? So the cost of an asset is how you initially measure it. And we'll get into detail, I think, in the next video around what constitutes the cost of an item of property, plant, and equipment. But for now, it suffices to say that the initial measurement is based on the cost. Then secondly, you then look at the current, in some instances where you don't actually purchase or acquire or construct the PPE item, but you maybe get it in a non-exchange transaction. Say, let's say it's a donation. So you're a hospital and an ambulance is donated to you. So what that does is there is no cost because you didn't pay money for it. So in such instances, the standard therefore requires you to measure it at current value, which could be the fair value or the current operational value, because you don't have an original cost. So you're going to use a deemed cost for it, which could be a current value. So that is the second instance. So the first one we said the cost, the second one now saying current value. In some instances, what then happens is you didn't purchase it, nor did you receive it in an exchange, but you actually exchanged assets with another entity. So you've got a motor vehicle, which you're currently using, but the other cancel, maybe you've got an ambulance, they've got excess ambulances. So you then decide, we'll give you this motor vehicle and you give us an ambulance. Okay. So the question is, I've received the ambulance, how do I measure it initially? So the standard requires that you measure it again at the current value. Okay, so you're going to measure it at the current value. Unless you can't determine the current value, you then measure it at the value of the asset given up. But in most instances, you're going to measure it again at the current value, which becomes the fair value or the current operational value there. Let's talk about cost. In the previous video, we say that cost, you measure at the initial measurement, you measure your asset at cost. So what is cost? So number one, cost, we're talking about the purchase price of an item of property, plant, and equipment, including any import duties paid. So let's say you are importing this asset and you paid import duties that should be capitalized, also including non-refundable taxes. Let's say you're not VAT registered and you paid VAT, then you then have to capitalize that cost. So that's number one. You're talking about the purchase price. Secondly, you're also talking about directly attributable cost. So as you're bringing that equipment, let's say you imported a motor vehicle, you're going to incur costs to do with transport, with all the different costs for you to bring it to this present location and condition. So these are directly attributable costs. But also directly attributable costs, we also then see them. Let's say we are constructing a building or an infrastructure asset. So what then happens is with those costs is you then incur cost of material, cost of labor, cost of all different types of costs, which are directly attributable. What I want to emphasize on directly attributable is that for you to say this cost is directly attributable, one way of testing it, it must be incremental to the decision to acquire or construct a PPE, which means the cost of existing staff. Let's say you've got an accountant who is now also being asked to do the accounting for the acquisition of this asset. The question is, should I then allocate his salary to that acquisition? The question is are you incurring this cost directly? In other words, is it incremental to the decision? In most instances, you're still going to pay the accountant the same salary, whether or not you acquire this asset. So that cost is not directly attributable. Then we've got dismantling cost. And I like dismantling cost because sometimes they don't come out clearly. So dismantling cost comes out where you're constructing an asset. Let me give you an example. You're constructing an asset and the law requires you to restore the environment at the end of the useful life of the asset. You're required to restore the environment to the way you found it. So we see this maybe in mines, where you're constructing a mine and you need to restore the environment the way it was. But we also find that where in some instances maybe you're building your structure in a land that doesn't belong to you, and the owner of the land says at the end of the useful life, please remove everything about your structure. We also see this where you're renting out an office and you do office partitionings and you invest in all these things. The owner of the property would say at the end of the agreement, you must remove all these things. So dismantling costs become part of your cost, which must be capitalized. But the challenge is that dismantling costs are happening not at the start of the asset, but rather at the end of the useful life of the asset. So it's a cost that is being incurred at the end. That's why a lot of people miss it entirely, because it's not a cost that we're incurring today, but rather 5 years, 10 years from now. But that cost is incidental to the decision to construct or to acquire this PPE asset. So it must be capitalized. So what we must do is for dismantling costs is that we are looking at the present value of those dismantling costs. So we must estimate how much we expect for those dismantling costs and then present value them to today. Another cost is installation. Obviously, these are obvious. When you buy an asset and you need to install it and assemble it, all those costs can be capitalized. Last but not least is we're also looking at testing costs. An item needs to be tested, okay? So when you're testing an item, the costs incurred in the testing phase are also costs related to the item of PPE and must be capitalized. Just another example where some instances where you could actually construct an asset and then it needs approvals before it can be used. So it needs to be approved, let's say, by the authorities. The cost of the approval process of the authorities coming to approve it is also part that can be capitalized. But in some instances, we then need to do an official opening. Let's say we invite, the president, the mayor, or councillors or MPs for the official opening of this asset. That cost is not capitalized because it's not necessary to bring the asset to a condition where you can use it, right? So just bear in mind that. Now we want to delve into subsequent measurement. So we have measured it initially, which means these are costs we've capitalized initially. How do we continue measuring it at the end of the month or at the end of the year? How do we continue measuring these items of property, plant, and equipment? So there are two models that the standard allows. The first one is the historical cost model, and the second one is the current value model, which in brackets here I've got revaluation. Now we're going to look at each of them individually so that we've got a good and comprehensive understanding of what each model is about. Let's talk about the historical cost model. So the historical cost model is the basic model for accounting for PPE. So number one, we've determined the cost based on the initial measurement. And under the historical cost model is we then carry this asset at cost less any accumulated depreciation and any accumulated impairment loss. So let's start with, let's say it's land. Generally, we don't depreciate land, right? So what it means is the original cost of the land, it continues at that cost unless and until you are convinced that there's some impairment that has happened, then you can impair it. But normally, in the absence of any impairment, the land is continued to be carried at the original cost. Then we come to the other assets which you then obviously depreciate. So once you've determined the cost, you must therefore make an assumption on, or rather an estimate or calculate your depreciation. Then every year you're depreciating the asset. So you're then carrying it at cost less accumulated depreciation. So this is the most straightforward and easy way of accounting for your PPE under the historical cost model. The second model that is allowed in carrying your property, plant, and equipment is the current value model. In this case, PPE is carried at revalued amount less any accumulated depreciation or accumulated impairment losses. So the difference between this model and the historical cost model is after we have an item of property, plant, and equipment, what we're going to do is regularly we revalue it, which means we go and establish what is the current value for that. And then we revalue it and then depreciate it, revalue it, and then depreciate it. So we don't continue carrying it at the original cost, but rather at a revalued amount. So the revalued amount can either be determined as the current operational value or the fair value of that asset. So depending on why we are holding this asset. So assets that generally we are holding for their operational capacity, which is their service potential, which is the bulk of assets in the public sector. So just think about infrastructure assets, just think about your bridges, you're thinking about your roads. It's mostly for their current, for the service delivery objectives. So we're going to value using the current operational value. Whereas assets that you're holding for their financial capacity, where you're expecting economic benefits, you then value this at fair value. Now, most people are familiar with the concept of fair value. And so the current operational value is not something that is that people are fairly, because it's also new, came through with Ipsas 46, which is measurement, which we're going to cover later in the course, where we then explain what is current operational value and what is fair value. But for now, it suffices to say that depending on whether you're holding the asset for its financial capacity or its operational capacity, you then determine what is the best way to measure them. Let's talk about revaluations. So we said in the previous video that you're going to revalue your asset. regularly. So number one, the policy on revaluations is done per class. I spoke earlier, you can go back and there's a video where we talk about determining the different classes. So once you've got the policy to say this is building, you then say, I'm going to carry my buildings at revaluation. What that means is you must revalue all the assets within that class. So you can't do selective revaluations. But also, because you can't do selective revaluations, what's important to note is that it doesn't mean, because sometimes we've got so many assets. Just think about if you've got a ministry responsible for all government buildings, the number of buildings, they could be into thousands and thousands of buildings. It's not practical for them to revalue them, all of them at the same time. So the standard allows you to do a process of where you can do revaluations on a continuous basis. So you're doing it, but in such a way that you're not doing selective revaluations. So you could split them into groups and then do groups at a time until the whole class is revalued. So not necessarily at the same time. Secondly, on revaluations, the standard says should be done with sufficient regularity to ensure that the carrying amount of the assets does not differ significantly from that which should have been determined using current value, which is the current value. It could be fair value or current operational value. So it doesn't mean that you must do your revaluations every year. You could do it every 2 years, you could do it every 3 years, where it's stable even every 5 years. But what's important is that it should be sufficiently regular to say that it's not sitting at something that is really off what that building is worth, depending on the model that you're currently using. Then also on revaluations, just to say that in Ipsas, we don't have, unlike IFRS, in the statement of financial performance, we don't have other comprehensive income. So any revaluation surplus or decreases are taken through direct into the statement of changes in net assets, right? So you're going to take a revaluation surplus into a reserve direct in the statement of changes in the net and the net assets. Right, very important. We want to talk about, so in this video, we want to talk about depreciation. I think when I was talking about the different policies, whether it's historical cost or revaluation, it kept coming, that depreciation, accumulated depreciation. So the expectation is that assets do depreciate. The only asset you don't depreciate is land. Right? All the other assets, the expectation is that you're going to depreciate them. Now, but depreciation is an accounting estimate, and I'm just going to talk about the different aspects that become very important considerations when you're depreciating assets. The first one is the need to depreciate separate components. So the standard says that within an asset, if a component is significant in value, it must be depreciated separately. So I want to give you an example. If you've got a building, right, one of the major components that you're going to see in a building could be the elevator system. And the standard is saying you must depreciate that separately. Now, your building could have a useful life of 8 years, but the elevator does not have the same useful life as the building. So can you see? That's why we then must depreciate it separately. So you might say, actually, I'll need to replace this elevator every 10 years. So what it means is, although you've got a building, but you're identifying the separate components within the building and depreciating those separate components separately. So the rest of the building over 8 years, but the elevator over 10 years, because after 10 years, you then replace it. You then have a new elevator, you depreciate it over 10 years. So you could have replaced the elevator 8 times over the useful life of the building. So that becomes a separate component. So that's number one. Number two is we also then have to make estimates on the residual value. So when you're talking about the residual value and also the useful life. So if you say, and I see a lot of entities might have a useful life of a motor vehicle, let's say 5 years. So you're saying we expect to use this car in this entity over the next 5 years period. Right? So that is an estimation of the useful life, which is the time that you expect to use that asset. But the useful life is not equals to the life of the asset, because depending on the policy, let's say you've got buses, so you are a national bus company. You don't keep your buses until they are run down. You're saying after a certain period, the maintenance cost becomes too high. So maybe our policy is that we only run a bus for 5 years. After that, we dispose it off. So the useful life becomes 5 years, which we expect to use the asset. But remember, at the end of 5 years, that bus is not worth zero. So you must then estimate that when we sell it, what is the residual value? So which means the cost minus the residual value gives you now the depreciable amount. So you depreciate your asset to the residual value. And I know a lot of entities actually don't do it, determining the residual value. So they depreciate their asset, let's say it's over 5 years, to zero. And then after 5 years, they still have this asset, they've not sold it, but that asset is sitting at zero. So you end up with a problem, which I think is rampant in the public sector, that are on Ipsas, of fully depreciated assets, which are still in use. The problem is that they were not determining the residual value of that particular asset. Now, so then the depreciation method also becomes very important. Most people default to straight line method, which is a problem in itself, because sometimes this is still an accounting estimate. So at times when you're talking about the depreciation method, you want a method that reflects the usage or the loss of value of the asset. So for an asset that is constant use, for example, like a building, then straight line makes sense. But for an asset like a machinery, which is used in production, so if you use straight line, you miss out that in some instances, it may be used more than in other instances. So certain assets might actually tell you that it can be used. Let's say you're buying a tipper, so you do a bit of road construction and there is a tip of the road, those big trucks that you use. And the issue is the useful life could be made in kilometers. So you say 500,000, that's the kilometers. What it means is, for some reason, and there is COVID, and you're not using the truck for an extended period of time, it's not really depreciated. Whereas when you use straight line method, it becomes the same. So you must determine what method works better under what circumstances. So that becomes very key. Then in terms of the accounting, depreciation is an expense. So that's number one. You treat depreciation as an expense, which means you're going to debit depreciation expense and credit accumulated depreciation. However, there are also instances where, let's say this asset is being used to make another asset. In that case, the depreciation is capitalized on another asset. So I'll give you an example. You've got a tipper, which is being used to make a road, right? So the depreciation of the tipper, because we bought this tipper to make the road, the depreciation of the tipper is not an expense, but the depreciation is capitalized to the road. So that's very important. It happens, you can capitalize it, it becomes part of the inventory cost, it can become part of the asset cost. So it's not that in all instances depreciation is an expense. In some instances, it might actually not be an expense.